The world's money just hit a wall. China isn't cutting off goods this time. It's cutting off capital. Billions in global investments into America are being quietly frozen in Shanghai's banking corridors. Across the Atlantic, the EU is baiting Moscow with $300 billion in seized Russian assets, daring Putin to walk away. Ships are stalled, gold is plunging, and no one's sure whose economy cracks first. Washington's, Beijing's, or Brussels itself. Because if China controls the money flow, and Europe rewrites ownership law, what's left of the global market we thought we understood? Pallets of neodymium alloy magnets sit behind taped-off aisles in Ningbo as customs data shows China's rare earth exports fell 31% in September from August, the third straight monthly decline and the lowest since February. A drop Reuters links to tightened export controls that began in April 2025. That number isn't just a trade statistic. It signals Beijing's readiness to use materials that underpin electric vehicles and missiles as instruments of pressure. Automakers and defense contractors depend on these magnets because China produces 90 to 98% of global magnet output and controls over 85% of refining capacity, according to AlixPartners and Goldman Sachs cited by Reuters. When those export licenses slow, entire Western production lines stall. Reuters reports exporters now face weeks-long reviews on license applications, coinciding with September's shipment slump. Over the first 9 months of the year, total rare earth magnet exports hit 39,817 tons, down 7.5% year-on-year. Germany, South Korea, Vietnam, the United States, and Mexico were top buyers. A separate survey underscored how deeply integrated this single Chinese choke point remains. More than 90% of magnet manufacturing and exports still flow from the same clusters in Inner Mongolia and Jiangsu. Bilateral trade mirrors that squeeze. China's exports to the United States have plunged, including a 34.5% year-on-year drop in May and 27% in September, according to customs data summarized by Reuters. It's not one-sided. Factory surveys show new United States orders shrinking at their fastest pace since 2023, erasing demand even as tariffs bite. The message from Beijing's planners is clear. They're willing to forfeit the United States market to consolidate autonomy at home. The same logic extends offshore. Reuters calculates China's share of global ship orders by tonnage has soared to about 73%, displacing South Korea and Japan as maritime superpowers. Control of hulls means control of routes. It's leverage that can't be matched by tariff. Washington's answer arrived through the ports themselves. Starting October 14, 2025, the United States and China began reciprocal port fees on each other's vessels, policy tools disguised as logistics. Executives told Reuters those fees will thin capacity, lift freight rates, and push the cost to consumers. The United States Trade Representative floated charges up to $1.5 million per call for China-built ships, while Beijing retaliated by blacklisting 5 United States-linked units of South Korea's Hanwha Ocean, knocking its shares down 5.8% that day. It was a symbolic inversion, the world's top shipbuilder using sanctions the way Washington once did. These maritime duels tie back to industrial ambition. A Reuters retrospective traced China's climb from 5% of global shipbuilding in 2000 to over 50% in 2023, while the United States slipped below 1%. That disparity means any American reindustrialization must import both capital and expertise, a vulnerability Beijing can exploit simply by stalling approvals for foreign investors. Agriculture shows the spillover. China imported no United States soybeans in September, the first zero shipment month in 7 years, Reuters reported October 20, 2025. Grain and magnet, ship and chip. Each channel reinforces a deliberate decoupling. AlixPartners told Reuters the cost of redesigning motors to reduce dependence on dysprosium and terbium will take years and billions, leaving Western manufacturers locked into Chinese supply for the foreseeable future. Gold's surge, really completes the triangle between trade, finance, and trust. By mid-October, it vaulted above $4,200 per ounce, then fell 5% in a single day, the steepest drop since 2020. The Financial Times linked the rally to, quote, central bank buying and safety demand, as investors weighed Fed cuts and tariff costs. Behind all this volatility lies a structural pivot, according to Reuters. Central banks have been adding over 1,000 tons of gold annually since 2022, much of it outside Western vaults, to hedge against reserve freezes. Those freezes now define Europe's geopolitical experiment. Roughly $300 billion in Russian sovereign assets remain immobilized worldwide, 210 billion euros of them in Europe, and 185 billion euros at Euroclear, Reuters detailed on October 6, 2025. Brussels wants to use the windfall income from those accounts to fund Ukraine, But, well, some member states favor leveraging the assets themselves as collateral for a €140 billion loan, a step Moscow brands as theft. The European Commission insists only profits, not principal, would be touched, yet legal advisors warn the line between use and confiscation is thin. A draft 12-point framework, reported by Bloomberg and summarized by Reuters, sketches a conditional path, sanctions eased in stages, reserves released only if Russia pays into Ukraine's reconstruction. For the Kremlin, the trade-off is existential: capitulate and lose leverage, or endure sanctions while selling oil east. The IMF, via Reuters, pegs Russia's 2025 growth at 0.6%, its central bank rate at 17%, and inflation still high. Proof that punishment and endurance, coexist. Each dataset reflects a world adjusting to weaponized finance. When China restricts magnets, when Europe debates seized reserves, when Washington taxes ships by origin, the old idea of neutral trade lanes, well, it collapses. Transactions now signal allegiance. The fiscal backdrop in Washington amplifies it. The Congressional Budget Office estimated a $1.8 trillion federal deficit in fiscal year 2025, about 6% of GDP, with interest payments surpassing $1 trillion for the first time. Reuters notes tariff revenues narrowed the gap slightly to $1.775 trillion, but that still ranks among the worst fiscal years outside wartime. High rates and high deficits leave policymakers grasping for non-monetary tools, and tariffs, port fees, and sanctions now double as fiscal levers. Europe's calculus mirrors that pressure. Reuters reports that several EU capitals want any loan backed by Russian assets to earmark proceeds for European weapon production, while Kyiv seeks freedom to spend where needs arise. If approved, it would mark the first time a Western bloc finances war through the yield of a rival's frozen wealth, precedent masquerading as policy. Zooming back to the docks, port executives told Reuters that the million-dollar surcharges on Chinese-built ships will feed straight into U.S. consumer inflation. Every diverted vessel, every delayed magnet license, and every frozen bond coupon adds another turn to the spiral-binding economics to geopolitics. China's gross domestic product for the third quarter rose by 4.8% year-on-year, slowing from the 5.2% seen in the second quarter, while fixed asset investment for January to September was down 0.5% year-on-year, the data show. The deceleration underlines how Beijing must weigh internal stimulus even as it levers external trade and investment policy. 2 days earlier, the Federal Reserve Governor Stephen Moran warned that renewed U.S.-China trade tensions pose a material risk to the U.S. growth outlook, evidencing how supply chain and investment blocking strategies don't remain region-specific but ripple into macroeconomic policy debates. On the investment front, Reuters reported on October 10, 2025 that Chinese firms seeking to invest in the United States face, pretty intense scrutiny over technology transfer, dual-use defense equipment, and telecommunications infrastructure. Meanwhile, Beijing is pressing Washington to relax additional tariffs and restrictions that limit Chinese investments in the U.S. market. The standoff really underscores how capital flows, traditionally engines of globalization, are now strategic arms in an interpower standoff. Meanwhile, automotive and metals industry sources told Reuters that global car makers are actively racing against Chinese export controls on rare earth elements, with China now controlling roughly 70% of mining, 85% of refining capacity, and about 90% of magnet production globally. Their concern is that if China goes further in restricting exports, Western factories could face shutdowns in just a few months. At the same time, on October 21, 2025, the Dutch economy minister and his Chinese counterpart met yet failed to resolve a standoff over Dutch-based chipmaker Nexperia BV, which China blocked from exports to Europe, while German automakers warned production shortages unless licenses move faster. The link between chip territories and auto manufacturing highlights how industrial and national security policies now, really overlap. Turning back to Russia, in Europe, the legal and financial complexities deepen. On October 22, 2025, Italy's Prime Minister Giorgia Meloni said any plan to use Russia's frozen assets must respect international law, even as the EU debates tapping up to €185 billion of approximately €210 billion in Russian sovereign assets frozen in Europe. The move reflects a strategic pivot, Western financial capital becoming a war-fighting asset. Also in October 2025, Reuters reported that Ukraine resists EU proposed conditionality in a potential $163 billion loan backed by frozen Russian assets, pressing for autonomy in how funds are spent rather than limiting them to European-made weapons. That tension reveals how even within alliances, financial engineering is a terrain of strategic contest. In policy trade shooting, we also see on October 16, 2025, China's Commerce Minister Wang Wentao publicly stating that intensive U.S. restrictive measures after a Madrid meeting undermined bilateral trade talks and harmed China's interests. The language signals how Beijing perceives investment and export curbs as not merely economic tools, but diplomatic provocations. On the legal finance front, on October 1, 2025, the Kremlin warned European leaders that any move it deems confiscation of Russian sovereign funds would undermine trust in the euro area banking system and property rights globally. The threat frames frozen assets not just as cold imposed constraints, but as potential triggers for a global shift in reserve strategy norms. A Reuters explainer dated October 6, 2025 put the global frozen Russian asset tally at about $300 billion, with 210 billion euros of that held in Europe and 185 billion euros in accounts at Euroclear. If Brussels proceeds with securitizing those 210 billion euros and Beijing keeps metering magnets while fortifying maritime control, the next global signal may not come from a central bank communique at all, but from an invoice of a single ship rerouted at the last minute, charging $1 million just to cross an ocean that used to be neutral. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.